If you own or operate a business that leases property or equipment, you're probably already familiar with the concept of lease accounting. However, with the implementation of the new lease accounting standard, ASC 842, both lessees and lessors face changes in how they recognize and report leases. Hi, I'm Lauren Barr, CPA and VP of Finance at Occupier, and today we'll explore the differences between lessee versus lessor accounting under ASC 842. First, let's review lessees versus lessors. A lessee is the person or organization renting an asset from the owner. The lessor, they pay rent for the asset's use, maintain it, and return it in good condition at the end of the lease. Businesses may lease equipment, vehicles, buildings, or other assets. A lessor, on the other hand, is the owner who leases the asset to the lessee for a specific period. They maintain the asset or offer support during the lease and receive regular payments from the lessee. Lessors can be equipment or vehicle rental companies, real estate firms, or other businesses leasing assets. The key differences between lessee and lessor accounting under ASC 842 are: 1, the recognition of leased assets and liabilities. Lessees are required to recognize lease liabilities and right-of-use assets for all leases, while lessors do not recognize lease liabilities because they're not paying anyone. The second difference is the expense and revenue recognition. Lessees recognize lease expense on a straight line basis for operating leases and both interest and amortization expense for finance leases, while lessors recognize lease revenue on a straight line basis for operating leases and both lease revenue and interest income for finance leases. The next area is discount rates, and lessees can use the incremental borrowing rate to calculate the present value of lease payments, while lessors will likely use the implicit rate of return of the asset or their incremental borrowing rate, whichever is lower. Lastly, in a sales type lease, lessees recognize both a lease liability and a right of use asset for sales type leases. The lessor is considered to have sold the leased property to the lessee and therefore recognizes a gain or loss on the sale immediately. In conclusion, understanding the accounting differences between lessees and lessors is crucial for both parties to comply with ASC 842. This standard applies to leases with terms over 12 months, impacting businesses of all sizes and industries. And despite the initial challenges, ASC 842 aims to provide a transparent view of lease obligations and assets. Understanding the key differences in accounting treatment will help you navigate the changes and comply with the new lease accounting standard.
If you need any additional resources, then click the link below to our Lease Accounting Resource Hub. The team at Occupier is happy to support your in-house or outsourced CPA in ongoing compliance. Happy lease accounting!